Did you know that half of American families will face financial hardship if the household primary earner was to pass away today? And 1 out of 4 families would not be able to cover their mortgage or pay groceries without going into massive debt. All of those because of the obvious fact that there is a loss of revenue, but also the funeral costs and the inherited debts that are transferred to the succession. A lot of these issues could be avoided by a simple term life insurance policy. Often people do not own any simply because they do not understand how it works, and especially because they think that it's often more expensive than it really is. To give you an idea, it's actually pretty common to see people with over $100,000 of protection for less than $20 a month. And by the end of this video, you'll know exactly what term insurance is, how it works, and how it can benefit you and your family. But before we do, please give a like to the video to support the channel and subscribe for more financial content like this. Okay, so what is term life insurance? At its core, it's just a contract. This contract can be resumed in 4 key points. First, the coverage amount. That's how much money must be given to what we often call beneficiaries when an insured person passes away. Second, the term length. That's how long the contract is active. Third, the premium. That's how much the policyholder pays to keep the contract active during the term length. Fourth, the beneficiaries. They are the people who receive the money if the insured person dies. Here's an example of how it works. John, who is a healthy 40-years-old man that doesn't smoke or suggest any obvious risk, has a 20 years long-term life insurance contract with $100,000 of coverage with his spouse Vanessa as the main beneficiary. This policy costs him a premium of $15 a month until the 20 years are over, meaning he will pay until he's 60. If John passes away between the 20 years of the policy, Vanessa gets $100,000 from the insurance company. If John passes away after the 20 years, Vanessa gets nothing since the insurance contract is over. This example of an individual term life insurance contract is one of the most basic forms of this policy. There are other variants such as the first death policy, especially useful for a couple where both are insured, and when the first partner passes away, the death benefit is given to the living partner. Let's pick the John and Vanessa example again with $100,000 of coverage in a 20 years first death term life insurance policy for $25 a month. If Vanessa passes away within the 20 years, John gets $100,000. If John passes away within 20 years, then Vanessa gets the money. If both live, the policy ends with no money given to anyone. Now, when it comes to how the premium is calculated, the 5 main factors are usually your gender, your age, your health status, tobacco habits, and risk status. So, for the same 20 years contract with $100,000 coverage, if you simply change the age of John, it could have cost him $10 at 20 years old and $100 at 60 years old. See the difference simply by changing the age? So why would anyone want this? Well, think about the people who depend on your income. Maybe it's your kids, maybe it's your spouse, or maybe it's just to cover debts like a mortgage. Term life insurance is usually one of the cheapest ways to make sure that if you're not around, the people you care about aren't left in financial chaos. That's why most financial experts recommend term life for young families. It gives a lot of protection for not much money, especially compared to other insurance types. So let's weigh the pros and cons. Among the pros, it's one of the cheapest life insurance for the coverage amount. For most people, it's also simple to understand, and it protects your family during the years you need it most. Among the cons, if you outlive the term, there's no payout. And it doesn't build cash value, so you can't borrow against it like some other policies. But here's the thing. Most people don't actually need life insurance forever. They just need it until their kids are grown or debts are paid off. So for a lot of families, the con isn't really a big deal. Now let's talk about mistakes people make with term life insurance that you don't want to make as well. 1. Getting too short of a term. For example, choosing a 10-year policy when your kids are 5 years old. By the time they're 15, your policy ends, and you might need another one that's way more expensive. 2. Not getting enough coverage. A lot of people pick $100,000 because it's cheap, but that may not even cover a few years of living expenses for your family. 3. Waiting too long. The younger and healthier you are, the cheaper it is. Waiting until you're older means higher premiums, sometimes double or triple. Now, some of the questions people often ask themselves are the following ones. What happens if I cancel early? You just stop paying and the policy ends. No refund, no payout. Can I renew when the term ends? Sometimes, but it'll cost way more because you're older. That's why it's smart to pick a term long enough to cover your biggest responsibilities. How much coverage do I need? A common rule of thumb is 10 to 12 times your annual income. So if you make $50,000 a year, you might look at $500,000 to $600,000 in coverage. But if you want more certainty, talk to a licensed financial expert to confirm. So there you have it. If you found this helpful, hit that like button and subscribe for more financial content like this. And if you're curious about how other life insurances work, click on the videos showing in your screen right now.